I made a decision last week that surprised everyone who knows my investment philosophy. After holding physical silver for over 8 years and consistently advocating for precious metals ownership, I sold 80% of my silver positions. Not because I have lost faith in silver's long-term prospects, but because I believe mining stocks offer superior risk-adjusted returns under current market conditions. This wasn't an emotional decision or a reaction to short-term price movements. This was a calculated strategic shift based on changing macroeconomic conditions, valuation discrepancies, and leverage opportunities that didn't exist when I first began accumulating physical silver in 2016. Let me explain exactly why I made this move, which specific mining companies I'm targeting, and how current market dynamics create what I believe is a once-in-a-decade opportunity for informed investors who understand the difference between owning metal and owning metal producers. The decision started with a simple observation. Physical silver has performed exactly as expected over the past 18 months. Prices have moved from the mid-20s to the low 30s, providing solid returns and portfolio protection during a period of monetary uncertainty. But mining stocks have lagged significantly, creating valuation gaps that don't reflect underlying fundamentals. Silver mining companies are trading at price-to-earnings ratios that suggest silver prices around $18 to $20 per ounce. Meanwhile, silver trades above $30 and shows every indication of moving higher over the next several years. This disconnect creates leverage opportunities that physical silver ownership simply cannot provide. When I purchased physical silver between 2016 and 2020, the average cost was approximately $22 per ounce. Current prices around $31 represent a 40% gain over 8 years. Respectable returns, but nothing extraordinary considering the monetary expansion and inflation we've experienced during that period. Compare that performance to what mining stocks could deliver if silver prices continue rising toward $40 or $50 per ounce. Mining companies don't just benefit from higher silver prices. They benefit exponentially because their costs remain relatively fixed, while revenues increase directly with metal prices. Consider a mining company with all-in sustaining costs of $22 per ounce. At $30 silver, they generate $8 per ounce in profit margins. If silver reaches $40, profit margins increase to $18 per ounce, more than doubling profitability. That operational leverage translates directly into stock price appreciation that typically exceeds the underlying metal's performance. But operational leverage cuts both ways. When silver prices decline, mining stocks fall much harder than physical metal. This is why I maintain large physical silver positions during periods of price uncertainty. Physical silver provides stability and wealth preservation. Mining stocks provide leverage and growth potential. Current macroeconomic conditions suggest we're entering a period where silver prices are more likely to rise than fall over the next 3 to 5 years. Central bank policies, industrial demand growth, supply constraints, and geopolitical tensions all support higher precious metals prices. In this environment, the leverage provided by mining stocks becomes more attractive than the stability provided by physical ownership. The specific companies I'm targeting share several characteristics that distinguish them from the broader mining sector. First, they have low-cost operations with all-in sustaining costs below $25 per ounce. This provides substantial profit margins at current silver prices, and enormous leverage if prices continue rising. Second, they have strong balance sheets with minimal debt and sufficient cash flows to fund operations and growth without relying on external financing. Mining is a capital-intensive business that requires continuous investment in equipment, exploration, and development. Companies that can self-fund these activities avoid the dilution and financing risks that plague heavily indebted miners. Third, they operate in politically stable jurisdictions, with established mining infrastructure and reasonable regulatory environments. Mining in unstable regions or countries with unpredictable governments adds unnecessary political risk to an already volatile sector. Fourth, they have proven management teams with track records of successful mine development and operation. Mining is an execution business where experience and competence matter enormously. Good management can create value even in challenging conditions, while poor management can destroy value even when commodity prices are favorable. The first company that meets all these criteria is Hecla Mining, a US-based silver producer with over 130 years of operating history. Hecla operates mines in Idaho, Alaska, and Mexico, providing geographic diversification while maintaining exposure to stable jurisdictions. Their all-in sustaining costs average approximately $19 per ounce, providing substantial margins at current silver prices. Hecla's balance sheet shows minimal debt and strong cash generation capabilities. They've invested heavily in mine development and exploration over the past several years, positioning themselves for increased production as silver prices rise. Management has demonstrated discipline in capital allocation and operational execution over multiple commodity cycles. What makes Hecla particularly attractive is their combination of current production and future growth potential. They produce approximately 13 million ounces of silver annually from existing operations, but they also control significant undeveloped resources that could support production expansion if economic conditions justify development investments. The second company I'm targeting is Pan American Silver, a Canadian-based producer with operations throughout the Americas. Pan American operates mines in Canada, Mexico, Peru, Bolivia, and Argentina, providing the benefits of diversification while exposing investors to some of the world's most productive silver districts. Pan American's scale advantages allow them to maintain lower costs and better access to capital markets compared to smaller mining companies. They produce approximately 25 million ounces of silver annually, making them one of the largest primary silver producers globally. This scale provides operational efficiencies and financial stability that smaller companies cannot match. Their all-in sustaining costs average approximately $21 per ounce, slightly higher than Hecla, but still providing excellent margins at current prices. Management has focused on optimizing existing operations while pursuing strategic acquisitions that add high-quality assets to their portfolio. Pan American's balance sheet is conservative with manageable debt levels and strong cash generation. They maintain financial flexibility to pursue growth opportunities while returning capital to shareholders through dividends and share repurchases when appropriate. The third position I'm establishing is in First Majestic Silver, a Mexican-focused producer with a portfolio of operating mines and development projects. First Majestic produces approximately 12 million ounces of silver annually from mines located in Mexico's most productive silver districts. Mexico offers advantages for silver mining, including established infrastructure, skilled labor, and geological endowments that support large-scale, long-life mining operations. First Majestic has developed expertise in Mexican mining operations that provides competitive advantages in acquiring, developing, and operating mines in the region. Their cost structure averages approximately $23 per ounce all-in sustaining costs, providing solid margins while maintaining room for operational improvements. Management has focused on increasing production through mine optimization and expansion projects that leverage existing infrastructure investments. First Majestic's growth profile is particularly attractive because they control several development projects that could add significant production capacity over the next 5 years. These projects are already permitted and partially developed, reducing execution risks while providing clear pathways for production growth. The allocation strategy I'm implementing dedicates 40% to Hecla, 35% to Pan American, and 25% to First Majestic. This weighting reflects my assessment of each company's risk-return profile and growth potential under different silver price scenarios. Hecla receives the largest allocation because of their strong balance sheet, low costs, U.S. operations, and experienced management team. Pan American receives significant allocation because of their scale, diversification, and operational efficiency. First Majestic receives smaller allocation because of higher geographic concentration risk, but their growth potential justifies meaningful exposure. This allocation strategy provides exposure to different mining jurisdictions, operational scales, and growth profiles while maintaining focus on companies that meet my quality criteria. The strategy also provides flexibility to adjust allocations based on relative performance and changing market conditions. The timing of this strategic shift reflects my assessment of where we are in the precious metals cycle. Silver has moved from deeply undervalued levels toward fair value, but it hasn't reached the overvalued levels that typically mark cycle peaks. Mining stocks remain undervalued relative to metal prices, creating opportunities for investors who can tolerate higher volatility in exchange for leverage potential. Industrial demand for silver continues growing from solar panel manufacturing, electric vehicle production, 5G infrastructure development, and other technology applications that require silver's unique properties. This demand growth provides fundamental support for higher silver prices that should persist regardless of short-term economic fluctuations. Supply constraints in silver mining create additional support for higher prices. Most silver production comes as a byproduct of copper, lead, and zinc mining rather than from primary silver mines. This means silver supply doesn't respond directly to silver prices, creating potential for sustained price increases when demand exceeds available supply. Central bank policies worldwide continue supporting precious metals prices through continued monetary expansion and currency debasement. Even as inflation rates moderate, the underlying monetary conditions that drive investors toward hard assets remain intact. Real interest rates remain low or negative in most developed countries, making non-yielding assets like silver more attractive relative to bonds and cash. Geopolitical tensions provide additional support for precious metals as insurance against currency instability and financial system disruption. The weaponization of financial systems through sanctions and restrictions on international payments motivates countries and individuals to hold assets that provide independence from government control. The risk management aspect of this strategy acknowledges that mining stocks are inherently more volatile than physical metals. I'm maintaining 20% of my original silver position in physical form to preserve some stability and insurance benefits. This physical position provides downside protection, while the mining stock positions provide upside leverage. The physical silver I'm retaining is held in secure storage outside the banking system, providing true portfolio insurance that doesn't depend on counterparty performance or market accessibility. This portion of the portfolio serves as crisis insurance rather than return generation, which is why I've reduced its size relative to the growth-oriented mining positions. Stop-loss strategies for the mining positions are set at levels that would preserve most of the capital transferred from physical silver sales. These stops aren't based on arbitrary technical levels, but on fundamental valuations that would suggest my thesis about mining leverage is incorrect. If silver prices decline below $25 per ounce for extended periods, the mining positions would likely face significant pressure despite their strong operational characteristics. At those price levels, I would consider reducing mining exposure and potentially increasing physical silver allocation again. Conversely, if silver prices rise above $40 per ounce, I would consider taking partial profits from mining positions and potentially increasing physical allocation to lock in gains and reduce portfolio risk as valuations become extended. The portfolio monitoring process involves tracking both silver prices and mining company fundamentals on an ongoing basis. Quarterly earnings reports provide insights into operational performance, cost management, and capital allocation decisions that affect long-term value creation. Production reports and exploration results provide forward-looking indicators about future growth potential and resource development that could support higher valuations. Management conference calls and investor presentations provide qualitative insights about strategic direction and competitive positioning. Industry conferences and mining analyst research provide broader context about sector trends, regulatory changes, and technological developments that affect mining operations and profitability. This information helps inform allocation decisions and position sizing as conditions evolve. The tax implications of this strategy were considered carefully before implementation. Physical silver held for over 1 year qualifies for long-term capital gains treatment, providing tax efficiency for the realized gains. The mining stock positions will be managed with attention to tax optimization through holding periods and loss harvesting when appropriate. Dividend income from mining positions provides current income that physical silver cannot generate, though mining dividends can be irregular and depend on commodity prices and cash flow generation. This income potential adds to the total return potential of the mining strategy. The psychological aspects of this transition required adjustment because mining stocks demand more active monitoring and decision-making compared to physical silver ownership. Physical silver can be bought and held for years with minimal attention, while mining stocks require ongoing evaluation of operational performance and market conditions. This increased involvement is both a benefit and a cost. The benefit is greater potential returns and more precise portfolio management. The cost is increased time requirements and emotional involvement in shorter-term price movements that don't affect long-term value. Market volatility in mining stocks can be intense, with daily price movements of 5 to 10% being common during periods of uncertainty. This volatility provides both opportunity and risk that requires emotional discipline and clear strategic thinking to navigate successfully. The confidence in this strategic decision comes from understanding that both physical silver and mining stocks benefit from the same long-term trends supporting precious metals prices. The choice between them is primarily about risk tolerance, return objectives, and personal involvement preferences, rather than fundamental differences in outlook. Mining stocks amplify silver price movements in both directions, making them appropriate for investors who believe silver prices will rise significantly over the next several years. Physical silver provides stability and insurance benefits that make it appropriate for investors primarily concerned with wealth preservation. My assessment suggests current conditions favor the leverage approach over the stability approach, but this could change as market conditions evolve. The strategy includes flexibility to adjust allocations based on changing risk-return dynamics and valuation relationships. The specific mining companies selected represent what I believe are the highest quality opportunities in the silver mining sector. They combine operational excellence, financial strength, and growth potential while operating in reasonable jurisdictions under experienced management teams. These companies should outperform both physical silver and the broader mining sector if silver prices continue rising as expected. They also provide better downside protection than lower quality mining companies if silver prices disappoint expectations. The decision to sell 80% physical silver holdings wasn't made lightly or quickly. It represents a strategic shift based on careful analysis of changing market conditions and opportunity assessment. The confidence comes from understanding both the opportunities and risks involved. This strategy won't be appropriate for every investor, but it reflects my best assessment of how to optimize precious metals exposure under current and anticipated market conditions. The focus remains on silver as a long-term store of value and inflation hedge, but the implementation has shifted toward leveraged exposure rather than direct ownership.